Hey everybody, Dave Brown with First Class Lending. Today we're going to talk about 10 of the most commonly used mortgage terms. I'm going to start just with the first 5 in this video, so stay tuned for the next video for the remaining 5. The first one I want to talk about is APR, annual percentage rate. What the heck is that? Well, there's an interest rate that determines your payment on your mortgage loan. Let's say it's 2.75, all right? The annual percentage rate takes into consideration your interest rate you're paying on the loan plus the costs associated with getting that loan, and it amortizes it into an annual percentage rate. Here's a real easy example I think that will help you make a little more sense of this. Let's say you borrowed $100 and it was at 10% interest. You would pay back $10, right? Let's say though that lender charged you $1 to process that loan. So now instead of paying back $10, you're paying back $11, and your interest rate is 10%, the 10% that was set for the loan, but the APR is now 11% because it cost you $11 in total that you paid over the first year, $10 in interest, $1 in cost, total of $11. That's how we get the APR calculation. Amortization, that's our next term. What is amortization? Well, amortization is a formula that when you borrow money, you're paying back a little bit of principal and a lot of interest in the beginning, and then with each payment you pay back a little bit more principal and a little bit less interest, and it keeps going like that until the loan is paid off. That's amortization. Debt to income ratio, or DTI, you'll hear us call that in our industry. We look at 2 ratios for folks. One is their housing debt to income ratio, so that's their principal, interest, taxes, and insurance, their housing payment, relative to their gross monthly income. And then we look at all of their debt. So in addition to their housing expense, we add in their car loans, their student loan debt, their credit card payments, basically anything that's going to show up on a credit report with a monthly payment. All of that is added up relative to their total income, gross monthly income, and we look at those 2 ratios, and there are guidelines, and the guidelines vary from program to program. Loan to value. Loan to value is the percentage of the loan relative to the value or the purchase price of the home. So if somebody's buying a home for $500,000 and they want a loan for $400,000, $400,000 is 80% of $500,000, so the loan to value in that example is 80%. PMI. PMI stands for private mortgage insurance. What is that for? Well, in most cases, when somebody puts down less than 20% and their loan to value that we just talked about is above 80%, most lenders want to have private mortgage insurance on that loan. It's an additional insurance policy that the borrower is required to pay. And what it does is, in the event of a foreclosure, that insurance policy then kicks in and gives the lender a percentage of the loan amount, so it helps mitigate any potential loss. And mortgage insurance is actually a great tool, because without it, it would be very difficult for a lot of people to buy homes with less than 20% down. Hope those made some sense. If you have any questions on any of it, give us a call.